Hello everyone, welcome to my channel. Today I'm going to talk about how double entry bookkeeping works. The process. Let's get into the video. The first step in double entry bookkeeping is identifying financial transactions. A transaction is any event that has a monetary impact on the financial position of a business. Examples include purchasing inventory, receiving payments from customers, or paying salaries to employees. Second step is determining accounts affected. Once a transaction is identified, the next step is determine which accounts are impacted. For every transaction, there must be at least two affected accounts. For example, when a company buys equipment, it affects both the cash and equipment accounts. Step 3 is applying the debits and credit rules. After identifying the accounts affected, the next step is determine which account to debit and which account to credit. The general rules for debit and credits are as follows. Assets, debits increase assets, credit decrease them. Liabilities, debit decrease liabilities, credit increase them. Equity, debits decrease equity, credits increase them. Revenue, debits decrease revenue, credits increase them. Expenses, debits increase expenses, credits decrease them. Step 4. Recording the transaction. With the accounts and the debits and credit rule in mind, the transaction is recorded in the company's general journal. The general journal is where all transactions are initially entered, showing both the debit and credit sides of each transaction. The journal entry should include the date of the transaction, the accounts affected, the amounts debited and credited, a brief description or explanation of the transaction. For example, if a company buys $1,000 worth of office supplies on credit, the journal entry would be debit office supplies for 1,000 and credit accounts payable credit 1,000. In this case, the company debits the office supplies account, which is an asset, because it has increased its office supplies. Simultaneously, it credits accounts payable, a liability, because the purchase was made on credit, increasing the company's first liabilities. Step 5 is to post to the ledger. After recording the transaction in the general journal, the next step is posting it to the general ledger. The general ledger is where each account's transactions are tracked individually. Each account, such as cash, office supplies, or accounts payable, has its own section in the ledger, showing the debits and credits over time. Continuing with the example, the debit to office supplies and the credit to accounts payable are posted to their respective ledger accounts. Over time, the ledger provides a detailed record of all transactions affecting each account. Step 6. The trial balance. Once all transactions for the accounting period have been posted, a trial balance is prepared. The trial balance is a list of all accounts and their ending balances, with debits on one side and credits on the other. The total of all debit balances must equal the total of all credit balances. If the trial balances does not balance, it indicates an error in the bookkeeping process, which needs to be corrected before moving on. Step 7. Financial statements. Once the trial balance is accurate, the data is used to prepare the company's financial statements, including the income statement, balance sheet, and cash flow statement. These statements provide insights into the company's financial health and are essential for stockholders, including investors, creditors, and management. Thanks for watching this video, and do not forget to subscribe to my channel.